Well, good morning. Nirendra Rana here. The topic of the day is physical climate risks. Physical climate risks. See, insurance companies rely on the law of large numbers to help estimate the value and frequency of future claims they will pay to policyholders. So, when it works perfectly, insurance companies run a stable business. Consumers pay a fair and accurate premium, and the entire financial system avoids serious disruptions. However, the theoretical benefit from the law of large numbers do not always hold up in the real world. The law of large numbers theorizes that the average of a large number of results closely mirrors the expected value, and that difference narrows as more results are introduced. So, with increasing climate risk, as pronounced emphatically in the recently released IPCC WGII report, India stands to be impacted across sectors. So in the last couple of years are any indication, India's insurance sector has led to bear the cost of increasing number of claims for climate-related disasters like cyclone and floods, as acknowledged by India's Insurance Regulatory Authority IRDAI's 2021 annual report, which acknowledged several natural catastrophic events like cyclones and floods, however, failing to provide guidance on risk assessment across climate hazards. So, India is one of the vulnerable countries in the world to climate-induced flooding, heat, stress, and droughts. According to the new IPCC WG2 report on impacts, adaptation, and vulnerability, India is exposed to many flood hazards from sea level rise, rivers, and melting glaciers. Major floods and landslides killed over 700 people and caused $11 billion worth of damage in India over the course of 2018 and 2019. So, Munich Re, India's largest insurer, agrees that storms, flooding, and drought are the key weather risks for the Indian region since they are unpredictable and extreme. These weather events are driving greater volatility in company losses, which makes structuring insurance solutions all the more challenging. In general, insurers have long relied on catastrophic models, which use historic loss data to price future risk. However, unprecedented climate conditions have made modeling future losses more difficult than ever before. So, the potential for major events to overwhelm an insurer's capacity to absorb climate related losses is very real. For example, in 2018, the Merced Property and Casualty Company was unable to pay out all claims due to the wildfires in California, and as a direct result was pushed into insolvency. So, in general, insurers have long relied on catastrophic models which use historical loss data to price future risk. However, unprecedented climate conditions have and will further make modeling future losses more difficult than ever before. So, increasing physical risk presents challenges both to market-based risk transfer mechanism and to the underlying assumptions behind Indian insurers' business model to spread the risk by repricing. Since India already has one of the lowest insurance penetration across Asia and much lower than the global average. So, a 2020 review of climate disclosure from the global insurance industry. Indian insurance companies were among the worst performers among their global peers. The ability of insurers to articulate their management of climate risk is not only important to their shareholders but also to the financial stability of the economy. A 2021 climate risk assessment survey across small, large, and medium industries in Maharashtra, including the insurance sector, revealed that nearly half feel the need to reassess business models and planning, while more than a third blame climate for capital destruction. 6 out of every 10 want to de risk from climate change and develop successful risk transfer mechanisms and pricing which adapt to the external environment. So, the insurance sector works as a mitigator of financial damage inflicted by untoward events and as a financial intermediary driving funds toward different investment avenues. So, the climate change risk facing India have the power to compromise both of these imperative functions that insurance plays and in the broader economy. The Indian insurance sector faces various challenges such as low insurance penetration and density rates, low rural participation of interest, etc. The market for specialty risks such as natural catastrophe is largely underdeveloped in the country. So, for example, flood risk in India is quite pronounced, but insurance companies bore less than 10% of the actual losses during the Kerala floods in 2018. With the onset of new risk assessment models will also be need to be thought through so as to best capitalize upon these opportunities. An area of concern that arises here is the ability of insurance or insurers to efficiently price these risks. India's insurance sector has potential to grow further due to the unprecedented or underpenetrated nature of the market and low density. So, climate crisis is there. We are in the thick of climate crisis. Its manifestation cannot be dismissed. The act of God or natural catastrophes. So, the return period of various climate events are shortening. Hence, the risk management, underwriting, and pricing ought to be robust. Assets build up and its aggregate, particularly in fragile geographies, needs to be watched and managed closely. Investments by insurers in anything that adversely affect humans, biodiversity, and the environment in general must be avoided. Climate risks are evolving rapidly and getting increasingly complex. Retrospective pricing models will not work. Risk modeling too needs to quick catch up. Insurers will not have the luxury of working in silos. Insurers need to evaluate their portfolios from the perspective of scope 1, 2, 3 emissions and ensure they are aligned to a net zero outcome. Last but not the least, insurers should have environmental, societal, and governance compliant boards. Say, climate change is projected to increase the likelihood and intensity of extreme weather events in India, threatening its people, agriculture, and infrastructure. So, infrastructure damage due to catastrophic incidents such as climate-induced floods or loss of lives due to heat stress are amongst the permanent impacts that will be witnessed in India, and therefore growing physical risk will influence the future availability and affordability of insurance protection, potentially threatening existing business models for the insurance industry. So, the insurance industry has an absolutely crucial role to play in climate resilient developments. First, by becoming number in making payouts, it can help people bounce back faster from the shocks of extreme weather events and ultimately weather events. Second, insurance premium can be very useful signal to prevent the buildup of infrastructure in locations that are exposed to climate hazards. As 2023 commences, or 2025 commences, or about to commence, the world faces a set of familiar risk inflation, geopolitical confrontation, and increased severity and frequency of climate related physical events are predicted to lead to higher claims and reduce the value of property investments, creating a substantial coverage gap and a tremendous impact on the reinsurance sector, with catastrophe premiums expected to soar this year. So, the past has reinforced the seriousness of climate change. While insurance companies offer companies peace of mind, the slow burn climate change crisis over the past 5 years has exceeded hundreds of billions of claims paid out by insurers from uninsured losses. However, if insurance payouts continue to increase due to more customers filing claims, the insurance industry either has to lower its profits or increase the regular premiums customer pay. So consequently, insurers need to understand how climate risks are likely to evolve under different climate change scenarios to identify where they are uninsurable. India is one of the most vulnerable countries to the impacts of climate change, ranking 7th out of 181 in the Global Climate Risk Index 2021. So India is among the front runners in terms of exposure of its infrastructure to the vulnerability of climate change, according to recent Global Physical Climate Risk Report prepared by Cross Dependency Initiatives. The organization, which specializes in physical climate risk analysis, assessed 2,600 regions across the world and ranked them as per their climate risk in 2050. So it found that 80% of the top 50 most at risk states and provinces in 2050 are in China, the United States, or India. and India. So the ranking is based on the aggregate damage ratio of the province. The damage ratio refers to the annual average loss from properties damaged by the extreme weather events as a fraction of replacement cost of that property. High ranking for this metric reflects states, provinces, and territories where a larger proportion of the total built-up area will be subject to damage from climate change and extreme weather event, even if the extent of that area may be small. So the report also analyzed the extent of percentage increase of damages between 1990 and 2050. So among the top 9 most vulnerable states in India, Assam reported the highest percentage increase in their damages by 331%, followed by Bihar 141%, Uttar Pradesh 96%, and Maharashtra 81%. So this is the climate risk, or you can say physical climate risk. Only the insurance companies can cover up this area, and insurance companies relies on the law of large number. So India, being the most vulnerable countries in the world to climate-induced flooding, heat stress and droughts, according to the new reports, India is exposed to many flood hazards from sea level rise, rivers, melting glaciers. So insurers have to come out with suitable coverages to cover these risks. Thank you. Thank you very much.